Real estate investment presentation, assumable mortgage. Get ready because we're raising the stakes with real estate. Assumable mortgage, referencing Investopedia, a place you can go to look up investment related terminology, continuing your research from there. An assumable mortgage is a type of financing arrangement whereby an outstanding mortgage and its terms are transferred from the current owner to a buyer. So we have a typical type of situation. We've got the seller, we've got the buyer. Typically, the seller often has a loan outstanding that they're using the home or the property as collateral. The buyer typically is going to be needing to take out a loan in order to get the funding generally to pay off the sales price. So under a normal circumstance, you would expect the buyer to be financing, taking out some kind of loan on the property in order to pay off the seller. The seller, once they get the money from the buyer, then is going to use part of that money typically to pay off the loan that they had using the property as collateral. So you might say, is it possible then, and under what conditions would it be beneficial for the buyer to just say, can I assume the mortgage that is already outstanding from the seller already having a mortgage, already having the property as collateral with it. So that's the idea of basically assuming the buyer then assuming the mortgage of the seller, who of course generally often has a loan outstanding. When would that be a beneficial thing to do, as opposed to the general situation if you weren't to assume, the buyer not assuming, which would be, once again, the buyer takes out their own loan using the property that they're purchasing as collateral in order to pay the seller taking that money and then paying off the loan that they had outstanding using the property as collateral when it was in their possession. So by assuming the previous owner's remaining debt, the buyer can avoid obtaining their new own mortgage. So it could save some complexity. You can imagine, hey, that seems kind of like a little bit easier. It might be in certain circumstances an easier process. Different types of loans can qualify as assumable mortgages, though there are some special considerations to keep in mind. Understanding assumable mortgages. Many home buyers typically take out a mortgage from a lending institution to finance the purchase of a home or property. That's generally the scenario because it's a large purchasing item. Typically, in order to finance the purchasing, the purchaser, the buyer, then needs a loan in order to help them with the financing using the property that they're going to be buying as collateral on the loan. Therefore, if they default on repayment of the loan, the lender has recourse to the property in the event of, say, like a foreclosure, to make sure they have security for the payment. The contractual agreement for repaying the loan includes the interest that the borrower must pay, as well as the principal repayments to the lender. If the homeowner decides to sell their home later, they may be able to transfer their mortgage to the home buyer. So if you have the property, if you're on the seller side of things, you typically will have the property and you have an outstanding loan at that point in time, and possibly then have the option of, when selling the property, to transfer the loan instead of getting the money from the buyer and then paying off the loan, making the buyer then presumably, if they need financing, takes out their own loan. So in this case, the original mortgage taken out is assumable, meaning, again, the seller then transfers the loan that they already have out in the process of the sales process to the buyer of the property. So understanding assumable mortgages. An assumable mortgage allows a home buyer to assume the current principal balance, interest rate, repayment period, and any other contractual terms of the seller's mortgage. So it has to be agreed upon, but if it is, then you've got the terms that are already laid out, right? We already have the principal balance. It is what it is at that point in time. If it's a fixed rate loan, for example, whatever the terms are on the interest rates, they're already been mapped out. They've already been agreed upon. The repayment period already set, whatever it is at that point in time. It is at that point in time, right? That would make it easier. And other contractual terms, whatever the other terms are for the loan, that would already be set if it was then transferred. So rather than going through the rigorous process of obtaining a home loan from the bank, a buyer can take over an existing mortgage. So in other words, it could be a little bit easier, you can imagine, because the terms have already been, negotiated if you're able to do the assumption or transfer the loan from one individual to the other from the seller to the buyer in this case. So understanding assumable mortgages continued, there could be a cost-saving advantage in current interest rates are higher than the interest rate on the assumable loan. Once again, this is a key point. There could be a cost-saving advantage if current interest rates are higher than the interest rate on the assumable loan. So if the seller locked in the rate, and they have a locked-in rate, and the current rate that the borrower would have to take, given the fact that rates have increased, are higher than the fixed rate that the seller has on the loan that's already outstanding on the property, then both parties could possibly work out a situation where the buyer assuming the loan would be beneficial because they can get access then possibly to that fixed rate, as opposed to taking out a current loan in the current environment where the actual loan costs would be higher. In that situation, again, you possibly could then work out an agreement where both parties would be benefiting from the fixed rate term, because that fixed rate has value to it, given the fact that it's lower than the current market rate. So in a period of rising interest rates, the cost of borrowing also increases. So obviously, if interest rates go up, then it's going to cost more to borrow. When this happens, borrowers will face a high interest rate on any loans approved. So if you're borrowing money at a higher environment of higher rates, then you'll be subject to higher rates than you would otherwise be. If you could assume the loan, you might be in a better situation if you have a fixed lower rate. Therefore, an assumable mortgage is likely to have a lower interest rate, an attractive feature to buyers. If the assumable mortgage has a locked-in interest rate, it will not be impacted by rising interest rates. So that's kind of the idea. We're imagining a situation where it's locked in. If it was a variable rate, then of course, assuming it, you'd be assuming the variable rate, which could fluctuate, and you might not have the same kind of impact here. If it was a fixed rate, and you have this situation where the market rates then change going up, then if you could pick up that fixed lower rate, that would be nice. So what types of loans are assumable? Some of the most popular types of mortgages are assumable, including the Federal Housing Authority, the FHA, Veterans Affairs, VAs, and the U.S. Department of Agriculture, USDA. Buyers who wish to assume a mortgage from a seller must meet specific requirements and receive approval from the agency sponsoring the mortgage. So obviously, you got to go through the approval process in order to get that done, but it might be an easier process possibly than going through the whole new loan process. So the FHA loans are assumable when both transferring parties meet the requirements for the assumption. For instance, the property must be used by the seller as their primary residence. Buyers must first verify that the FHA loan is assumable and then apply as they would for an individual FHA loan. The seller's lender will verify that the buyer meets the qualifications, including being creditworthy. So you still got the creditworthy requirement. If approved, the mortgage will be assumed by the buyer. Now, I mean, obviously, if you're the bank and you're trying to go through this process, you want to make sure that the buyer then, is likely to be paying back the loan, that it's going to be basically assumed. So you'd think you'd have the same kind of process of other factors involved, including, your creditworthiness and so on and so forth, in order to qualify and be able to make the assumption of the loan process happen. However, unless the seller is released from the loan, they are still responsible for it. So you still have this kind of situation where the seller, of course, when it becomes assumable, would like to transfer it to the buyer and not be responsible for it. In other words, if the buyer defaulted on it, they assumed the mortgage and they didn't pay it for whatever reason, does the bank then still have recourse to the seller who had the loan prior to that or not? Obviously, the seller in most cases would like to remove themselves completely from the process. It's now the buyer's responsibility. That's what they would like to have in being assumed. And the bank then, of course, should have recourse in that case to the property, but not hopefully to the seller who would like to remove themselves from the process, you would think generally. So VA loans. The Department of Veterans Affairs offers mortgages to qualifying military members and spouses of military members. However, to assume a VA loan, the buyer need not be a member of the military to qualify. So you could see the situation where you got the VA loan specifically designed for benefits for veterans. But if they were to say that the loans could not be transferred, then that would basically limit some of the benefits, right? So you would think then they're going to say, okay, we don't want to make a detriment here to the veterans. So it would be nice to have the transferability because that flexibility would be a beneficial thing. So can you then transfer a VA loan or to someone who's not in the military, right? That would be a key component. So, however, to assume a VA loan, the buyer need not be a member of the military to qualify, although the lender and the regional VA loan office will need to approve the buyer for the loan assumption, and most often, buyers who assume VA loans are military members. For loans initiated before March 1st, 1988, buyers may freely assume the VA loan. In other words, the buyer does not need the approval of the VA or the lender to assume the mortgage. So USDA loans. SDA loans are offered to buyers of rural properties. They require no down payment and often have low interest rates. To assume a USDA loan, the buyer must meet the standard qualifications such as meeting credit and income requirements and receive approval from the USDA transfer title. The buyer may assume the existing rate of interest and loan terms or new rates and terms. Even if the buyer meets all requirements and received approval, the mortgage cannot be assumed if the seller is delinquent on payments. Advantages and disadvantages of assumable mortgages. So what are the pros and the cons? The advantages of acquiring an assumable mortgage in a high interest rate environment are limited to the amount of existing mortgage balance on the loan or the home equity. So in other words, scenario being, you're imagining the seller has a fixed rate mortgage and the buyer would like to assume it because we're in a period of increased rates. Therefore, the current rates are higher than the fixed rate that is on the current loan that the seller has. And if the buyer was to finance without assuming the mortgage, they would have to then pay the higher rates. However, there's a limit in terms of how much financing you can have, and that's going to be the current loan balance on the seller side. So for example, if a buyer is purchasing a home for $250,000, that's the value of the property, that's the agreed upon sales price, and the seller's assumable mortgage only has a balance of $110,000. In other words, the seller has an equity difference of $250,000 minus the $110,000 at the point in time that they're selling, that difference then being $140,000. Then to make things nice and easy to just basically say, all right, I'm just going to buy the property for $250,000. I'm going to assume your current mortgage to make things nice and easy and lock in that lower rate. But in order to do that, I'd have to pay $140,000, which is the difference, which of course is higher than the standard 20% down. If the buyer's saying, I don't have $140,000, but I'd still like to assume the loan of $110,000, then they'd have to assume that loan and they'd need to basically take out a separate loan to secure the additional funds in order to meet that obligation. That can add a little wrinkle or complication in the process. So a disadvantage is when the home's purchase price exceeds the mortgage balance by a significant amount, requiring the buyer to obtain a new mortgage. So you could end up in a situation where the buyer then is going to end up possibly with two loans. Whereas if they were to finance it themselves, the loan amount might be small enough where they could have taken it in one loan, so it could add a bit of complexity in the process. They may still have to go through the process of qualifying for the second loan and so on and so forth, and dealing with this situation where now you got the two loans that are going to be involved and the banks dueling over, who has primary. Are they getting along? Are the two institutions getting along in terms of making this work and whatnot? So depending on the buyer's credit profile and current rates, the interest rate may be considerably higher than the assumed loan. So in other words, the second loan that you're going to need, because we're imagining you're in a higher situation in terms of higher rates and possibly given your credit ratings and so on and so forth, the rate on that second one might be higher. It also might have less priority than the first loan in the event of a default, meaning in the event of the default, the loan that you are assuming probably gets paid first. The second loan, if it gets paid second, then again, that's going to add more risk to that lender, which could result in basically higher rates on that second one. So usually a buyer will take out a second mortgage on the existing mortgage balance if the seller's home equity is high. So the buyer may have to take out the second loan with a different lender from the seller's lender, which could pose a problem if both lenders did not cooperate with each other. So now you got two lenders that are going to be involved, right? You're probably working with a bank or financial institution that might be different than the seller's financial institution that owns, the current loan that is outstanding. And then you got to make sure that the two financial institutions are cooperating with regards to the terms of the loan and the collateral and all that kind of stuff. So also having two loans increases the risk of default, especially when one has a higher interest rate. So advantages and disadvantages continued. If the seller's home equity is low, however, the assumable mortgage may be an attractive acquisition for the buyer. So if the seller's home equity is low, meaning the difference between the loan amount and the amount of the sales price, if that difference is still fairly low, assuming the loan could be quite good because you might be able to pay that off simply with the cash, right, for the difference and make things nice and easy. So for example, if the value of the home is $250,000 and the assumable mortgage balance is $210,000, meaning the seller is going to sell it for $250,000 and they have a balance on their loan currently outstanding at $210,000, imagining we're still in a situation where rates have basically going up, so they have a fixed rate that would be lower than the market rate or possibly even equivalent to it. And then you'd only have to pay the $40,000 difference, and you could just say, okay, I'm not going to take out a loan, and then pay you the $250,000, and then you pay off your loan of the $210,000. I've got the $40,000, and I like your loan terms, and so is there a way that I can just assume your loan terms and basically, you're selling it for $250,000, I'll assume the $210,000 here, and I'll just pay you the cash of the $40,000. That would be nice and easy and possibly allow you to get that fixed rate, which might be lower than the current market rate if that were the case. So if the buyer has this amount in cash, they can pay the seller directly without having to secure another credit line, which would be nice. Pros: buyer may get rates lower than the current market rates. That's one of the big benefits, and we'll work a practice problem in on this as well, because if you're the seller, you could take advantage of this as well. That attractiveness to the buyer could mean that you can actually possibly increase the price a little bit, and both the buyer and the seller benefiting then from the fact that you have a loan that has locked in a rate that is lower than the current market rate. That's worth something, and that could make it more attractive or possibly allow you to sell it for more than you otherwise would and still result in a benefit to both buyer and seller. So buyers may not have to secure new lines of credit. That could be difficult to do, so it might be easier in that sense. Buyer do not have a large out-of-pocket costs when the equity is low. The cons: buyer may need to substantial down payments when the equity is high. So again, the cons are oftentimes the seller has either paid down the equity on the loan or the home value has gone up over time, making a bigger spread, larger equity between the amount they're selling it for and the loan amount, which means that you got that bigger difference that you have to make up with either cash or second financing. Lenders may not cooperate when a second mortgage is needed. So when you have to have another mortgage involved with two different lenders, that complicates things. And with two mortgages, the risk of default increases. Assumable mortgage transfer approval: the final decision over whether an assumable mortgage can be transferred is not left to the buyer and seller. The lender of the original mortgage must approve the mortgage assumption before the deal can be signed off on either party. So in other words, obviously the lender is concerned it's going to be involved here, because if you made a commitment, if I was the seller and I made a commitment to the lender to pay back the lender, I cannot just go to some random person and say, I've now transferred my obligation to this other person, because the lender's going to want to say, hey, who is that other person? I made the deal with you. I trust you. I looked at your credit score. You're transferring it to this other person. Are they are they worthy to can I trust them? Are they going to pay off the loan? So obviously the lender is going to want to a say in terms of who you're transferring to. So the home buyer must apply for the assumable loan and meet the lender's requirements, such as having sufficient assets and being creditworthy. So are you assuming it to somebody else who the bank agrees with? You got to go through the same process and see if they're worthy of paying back, the loan. So, assumable mortgage transfer approval. If approved, the title of the property is transferred to the buyer and makes the acquired monthly repayments to the bank. If the transfer is not approved by the lender, the seller must find another buyer that is willing to assume his mortgage and his good credit. So obviously, if you're trying to sell the property and you're saying, hey, look, I've got a great loan that is also a benefit, then, and if you want to take advantage of that, because there is a benefit to it, possibly by even raising the price, and saying, hey, if you assume the mortgage, you're getting this benefit. You can possibly work with a good, create a good deal with a buyer and seller where both benefits in that situation. But to benefit, you got to find a buyer that could claim the loan, and they have to have the ability to do so and make the bank happy enough that you, who have the obligation to repay, are transferring it to someone that the lender also agrees with is creditworthy and can meet their obligations. So, assumable mortgage transfer approval, a mortgage that has been assumed by a third party, does not mean that the seller is relieved of the debt payment. So, you still got this situation of, okay, well, what if, it's assumed by somebody else? Is the seller kind of still on the hook? The seller may be held liable for any defaults, which in turn could affect their credit rating. So obviously, as the seller, that would be concerning, right? If you're doing an assumable mortgage, you want to make sure that you have straight as to whether or not you're still, on the hook in the event that there's a default or non-payment by the buyer, and so on and so forth. To avoid this, the seller must release their liability in writing at the time of assumption, and the lender must approve the release request, releasing the seller of all liabilities from the loan. So obviously, that's a key consideration, key point to keep in mind. So remember, we're referencing Investopedia. Investopedia, a place you can go to look up investment-related terminology and continue your research from there.